So our topic is investing in senior housing today. I'm Steve Monroe, name tag. So that's what we're going to be talking about. We're going to cover, things like, what are people looking for today? What might be out there in the future? What's going on with capital in the market these days? And obviously there's a lot of interesting things going on in the capital markets. But we're going to start talking about the hottest sectors of seniors housing. I mean, everyone is differentiated between, there's IL, there's AL, there's memory care, there's CCRCs, but standalone anything today just does not seem to be it. So, Rick, do you agree with that? That you've got to offer multiple levels of care in anything you're doing these days?
We pretty much do universally, so I would agree with that. We have a couple of properties that are independent living only, and the way that we think about assisted living is really a licensed product, but in our buildings you'll find 50-ish% of our residents buy no care services, so what is an IL versus an AL product is really essentially one and can vary from time to time. And we don't do any standalone memory care.
None.
Yeah.
Do you find that's, because a lot of people swear by standalone memory care, do you find that's, with all the overbuilding that's happened, is that kind of going by the wayside a bit?
It may not. I mean, some of it is just an exciting opportunity when you have entitlements for 40 units. What else are you going to do? And so people just say, okay, well fine, standalone memory care, because
that's not the reason.
More than you think.
Yeah.
But from our perspective, I mean, when we think about memory care, a lot of our memory care residents are residents that are in our communities that ultimately develop memory care needs over time. So when we're leasing memory care, we're doing two things. We're leasing somewhat from within and somewhat from outside of the community.
Scott, is there one area of senior housing today that, whether it's acquisition or development, that you are finding is kind of the hot area?
Well, I'm from Washington, D.C., so I answer all the questions with it depends, right? No pun intended on depends. Everybody with me?
We got it,
Scott. We opened a property this summer with Arbor as one of our operators. It's all memory care in Fairfax on Route 50 near 28. Folks who know that area near Dulles. And although it was a small property, 48 units, it basically, when we cut the ribbon, it was good to go. So that kind of flies in the face of standalone anything doesn't work. I think it does based on market. Same time, we are going long into active living.
We're going to get into that.
Okay, does that mean like skip?
Well,
That's what he said.
We're going to pause on that thought.
Okay.
But
the hot sectors that you're asking, I think our whole industry is a hot sector. It really is, and there's a lot of press. Thank God there's a lot of press. Thank God for you. Thank God that there's a lot of press on this sector, because I think it highlights the fact that this is really the ICO. The 12 real estate sectors, seniors housing continues to be the ICO. One is because it's very new. It's recession proof. As recession proof as something to be high yielding, and we've seen a flood of institutional capital coming to that. I know we're going to get on that topic as well, but that's because a great product has been delivered within this industry, and coupled with that is that it's new. It hasn't been figured out. With that, there are inefficiencies that make it, that create opportunity, and the demographics. When all's said and done, and you're doubting yourself about whether you should buy this property or you should build this property, you just look at that one statistic: 10,000 people turning 65 every day. Drop mic, right?
I could get in some arguments with you on that, but not tonight. We're not gonna go into that. But I have different opinion on what's going to happen with the boomers. But it's interesting that you have that standalone memory care, because that is not something you guys typically do.
That's correct. And truth be told, it was forced by the size of the property. You know, you had to go one story, 2 acres, Fairfax County, pretty much anything. You got to be a knucklehead not to succeed in Fairfax County, Montgomery County, Westchester County. Location is fantastic, but you know, that's a success story, but it's situational.
David, you have built, bought almost everything in senior housing. Fair statement?
It is.
Do you think there is anything that's hot right now, or do you think it's not that it's hot because too many people have gotten into senior housing in the last 5 years?
I know what to stay away from. Nursing homes, glad to say we're not doing that.
It's not senior housing.
Yeah, not senior housing. But I like the tried and true CCRC. I love the true Continuum of Care. And as much as some people may write every once in a while that CCRCs are dying, I say bring it on, because our occupancies are terrific. They're over 92 or 94% across the portfolio. There are huge barriers to entry. You don't need 2 acres. You need 100 acres, and there's not a lot of people looking to do that. So I really like CCRCs, and just even tonight, looking at Scott here, who's smiling and happy. If Erickson is happy, they must be doing okay.
Erickson, I know, is doing extremely well. But you looked at me when you said some people are saying that they're going to die. I hope that.
I've read those articles that our CCRC's dying.
Yeah, but did you read the answer?
Well, I do have a little ADD. Sometimes I don't get right to the end. I look at the headline.
I mean, that was supposed to get interest in people. They got to get to the end.
Okay.
Come on.
I'll work on that.
You know me. So do any of you guys think, looking forward 5, 10 years from now? I mean, Scott talked about, and we all know about the 10,000 people turning 65 every year. And it's just a question, what are these people, what are we, those of us who are boomers, what are we going to be wanting in senior housing? So look, put your crystal ball out there 5, 10 years out in the future, what's going to be hot? Because this thing's CCRCs, then it was assisted living, then it was memory care. Now it's AL and IL combined. Now everyone's building AL, IL, and memory care combined. What's the next thing? Anyone?
Hey, can I talk about it now?
Oh, okay.
I'm giving the green light.
Go ahead.
It's age-restricted housing. I think that's the front end. The front end of seniors are looking for age-restricted housing, and I subscribe to the whole philosophy earlier that people want to stay in their homes. I get that. Who wants change? In your later stages of life, it makes all sense in the world. But what people want, they want to liberate within this real estate. They want to liberate the value that they've accumulated within their house. They bought a house in 1962 for $35,000, and it's now worth $825. So you got that going for you. You can sell that and go into a age-restricted community that you're going to pay about $2,500 a month for, and you're going to be close to your kids and your grandkids, and you're also going to have a great community center. You have to have good programming with the community. You have to have somebody who's really coming up with things that are better than jump on the bus and go to Walmart for the day. You want better things than that. But at the same time, you want to be with like-minded people. We've done these focus groups on folks who have moved into our communities, our age-restricted communities. And one of the driving...
How many do you have up and running now?
We have 3.
Oh, I thought it was just 1 with 3. Okay.
Yeah. We have 3, but we got big plans for
a big pipeline.
Yeah. And the big thing with age-restricted housing is they want to be with like-minded folks. They want to be with, who doesn't want that, right? You want to be with folks that think the same way and act the same way. And a lot of folks, people who are in the same neighborhood but were in multifamily, were by the fact that they're walking on the treadmill and some 25-year-old woman is running on the treadmill next to them, and they're like, "This is weird for both of us, so let's get out of there." You know, it's that, and then you have restaurant clubs, you have wine tasting, you can accumulate a bunch of different activities and really step it up on your socialization within these communities, and that's what it's all about. We're social animals.
For those who are not familiar with what you're doing, tell everyone when Ben and I sat down with you at the NIC conference, I was shocked. I think Ben was shocked too. What's your average age of move-in for these communities that you're projecting?
Well, it's 55 and older, right? Nobody's going in there that's 55. I'm a year away from being 55. No way.
I think that's so long ago I can't remember.
God love you. You know, it's 72. It's 72 is what we're looking at, is folks going in there, and then you know, that's what you're seeing, and what it's doing to the industry, seniors housing, is we kicked out skilled nursing out of seniors housing. Is that right? Was that officially done? Okay. So skilled nursing's out, but what this is doing, similar to what we saw happening during the recession, is that independent living crowded out a lot of assisted living because people were just staying there a lot longer. Active living, 55 and older, is crowding out independent living. I think independent living I would short the stock of independent living communities.
So are you the one solely responsible for Holiday Retirement Corp's occupancy going down?
Yes, that was me. And it was a conspiracy that just worked like that.
Different
It was
price
awesome.
Let's talk about the development versus buy. I mean, we've all been in this industry for a while. Everyone was buying because it was cheaper to buy than to build, and acquisition prices went like this. And all of a sudden, the people got the pencils out, and it was like, God, it's cheaper to build now than to buy. So everyone started building. Then all of a sudden, in the period we're in now, acquisition prices peaked. Building costs, I'm told, have just escalated with labor and building materials, and I think it's going to get hit even more after Houston and Florida. So now it's kind of reversed. It seems to go up and down, up and down. David, where's the opportunity today?
Well,
when you look at
in my little niche, I think
build versus buy.
I like buying distressed versus buying stabilized. I think stabilized plays are nice, but I like a little more upside for that, and I like the creativity of turning the community around that hasn't worked well. But on the other hand, when I hear all the things about age-restricted housing, and I think, yeah, there's probably a good market there, but also no barriers to entry, so you have to be very careful where you pick to put them. You're not going to put them where 5 other guys are going to want to follow you in,
Amen.
Which is exactly what happened to the assisted living industry years ago, when every Tom, Dick, and Harry, rolled in, and then prices got cut. So I think you have to be very, very selective where you choose to build if you're going to be a builder. That's how I kind of look at that.
Okay. And then Rick, for you guys, is it more of a geographical decision, or do you really look at? I know you renovate a lot of buildings. You're not looking to buy versus build. You're enhancing.
Well, we're doing all of it, and I think it's also a duration question for us because we're a large management company. We develop, we redevelop, we sponsor deals, but ultimately, our time period is, we can do things for a 5 to 7 year time period. We could do things for a 10 to 20 year time period. We're in the long game. So from our perspective, it's a little bit different in that what we look for are, great acquisition redevelopment opportunities that are in outstanding real estate locations, and we'll totally scrape buildings and we'll put $40 or $50 million worth of capital to work in them and watch it go. And we've done that over the last in various sizes, from as small as $2 to $5 million to as much as $50 million in a deal. We've done $700 million worth of that stuff over the last 10 years, We also do ground up development, and when we do ground up development, it's in the highest barrier to entry markets. And so we're not, sticker shock doesn't bother us because we're a high rent business. We're in, when you look at kind of where we're located, our markets that we dominate, this one in New York, Boston, Philly, LA, Orange County, San Francisco, those gateway cities are going to continue to see large rent growth, and they have high barrier to entry. And they also have high regulatory, operational high barrier to entry. So from that perspective, I think we don't really look at it as like so much of the flavor of the month as just pure fundamentals.
And Scott, how about you guys? When did you form Capital Senior Housing?
2003.
2003. So you were originally buying assisted living, you had some independent living, you've now done some memory care. Then you started building, developing assisted living. Now you're developing active adult apartments, minimal services. So you seem to be, and I mean this in a good way, you're very opportunistic in terms of what you're, are you going to build, are you going to buy? You've built, and that got you bought, that got overpriced. You started building, that got crowded. Now you're switching into a different product type. So you're jumping around to where that opportunity is. So obviously it's the service type that seems to be most important to you, and you're kind of going now into the active adult.
All that's true. A lot of us in this room tonight have the highest class problem, that there's a lot of capital that's trying to find a place in this space, and they keep you in check by making sure that you put your money in with theirs. That's the private equity mantra. It's interest alignment. It's tried and true. With that though, you pick your poison, right? You're right. We started off cutting our teeth with opportunistic acquisitions. We find the property that's in a good market, good bones, maybe needs a refresh, maybe a change of management, but it's got a lot of good things going for it. And so you buy it, you commit to a CapEx program, you execute on your business plan, and good things happen, right? So with that, and that was the initial phase of our company. The thing that came out of that still holds true today is that the operator really makes the whole program happen. It's all about the operator. It's all about the operator. It's you can have a great, beautiful, brand new property with wet paint, smell, new carpet smell. You walk in, and if it's got a lousy, operator, people are falling asleep on the couch. It's gonna. Who wants that, right? We don't want that for our parents. And so that property's not gonna perform well. That's why we line ourselves with good operators like Atria to make sure that kind of thing happens. So we do that, but as you evolve, you get confidence within this market, and you keep coming back to the 10,000 people a day turn 65, and the fact that I've said this before, the big three REITs came in, and for a period of time, they were buying anything that didn't move. They were buying all the properties in the sector.
That didn't.
Yeah, exactly. And we all know that when a REIT gets a hold of a property, it's gone. It's not coming back. It's gone for good, right? So God love them.
Not now.
Yeah, exactly.
Not in this market.
Yeah. Well, yeah, you're seeing trips and droves. Here's a 10 property portfolio. Come on. They're buying hundreds of properties, and those are in there. God love them. They're running a business, and they should be good. So we saw 3 REITs go from 0 to hero within this wave. The three REITs that are in the top 10 of all the REITs, but they have gone ahead and sucked up all the properties, and so we decided that we're going to pivot and start producing new properties, and that's what really launched us into that. Plus the fact that we thought that the market and the industry is ready for phase 2 of this product type.
And it's something that they don't do either because, they don't want to enter that because of the dilution issues.
What do you mean?
They don't want to enter the development business
Right,
in nearly
right,
the same way
that's right.
because of the dilution issues.
Because
So
how
it's
they're
a
organized.
it's a perfect position.
Absolutely.
So David, do you have any CCRCs that you're planning on building ground up, or are you going to add on to the ones that you've bought?
I guess we would do a ground up if the perfect opportunity came our way.
Are you looking for the perfect opportunity?
Maybe that's why we haven't found it, Steve, is maybe we're not really looking for it. Really what we're looking for is more of the distressed or more of the turnaround than more of the ground up. But they're very hard to find a good ground up CCRC opportunity. And as Scott was saying, if the average age, if you think about it, if the average age of active adult is 72, then what does that mean for the CCRC resident? Well, that pushes it at least a decade. So now the average age of someone going into a CCRC is about 82 to 83. And so it's a little bit of a different type of market now than it used to be when we used to actually get residents who were on a new community, maybe late 70s. Now they're pushing another decade older as well. So it's a little bit of a different type of dynamic going on now in terms of the age of entry for, I guess, all senior housing.
Do you think that, so with that though, what's the wave of the future? Entrance fee or rental? Sorry.
You actually asked it better, and I actually think that entrance fees make a lot of sense only because you could build a much larger community that has a lot more amenities that you can't do with a rental. And I like the idea of being able to have a debt-free community or a close to debt-free community that the entrance fees allow you to do. And I think they can be very competitive in their marketplaces. But then again, I see some rental communities that, depending upon where they are and how restricted the market is, then they could look interesting as well.
So tack on question to that, is that
You only gave me 4 questions tonight, so this may press it a little. Okay.
But is that investor based or is that consumer based? In other words, that answer is it like, hey, we're going to do entrance free CCRCs because that's the way to finance these things. That's the way to organize them from a ownership standpoint. Or is like that's what the market wants.
Yeah, I think it's all customer driven. Because that's where the rubber meets the road. And as much as you would say, God, you have to have a great operator, I actually think you need a good operator, we all know that, but you need a great marketing department. And if your marketing department isn't able to reach out and find the right consumers for your project, then you're going to be in a world of hurt. And so finding that right project for that right consumer in that marketplace, I think that's really where the whole rubber meets the road. That it can get financed as a whole, that's nice too, obviously,
Sure.
But you have to make sure that that really works.
I'll add to that too. I think the not-for-profit model, they need to do the entrance fee because they don't have capital.
Now, I think the not-for-profit model, I've been saying this for over a decade, is finally going to die. I'm so happy that's going to happen. And I only hope that all these advanced refunding bonds and all this crap gets out of the marketplace, because I've never seen an industry where you take people who know absolutely nothing, you give them a couple $100 million, and they have no personal risk, no guarantees, and then you look at us poor for-profits
and have 30% greater FAR in some places to build.
Yeah, exactly. And don't pay any taxes. And then you have us who have to put up capital, sign our names.
Don't get angry. You're
It really bothers me. So I really hope that dynamic, for whatever reason in Washington, if you're paying attention there, if that changes with the bonds, I think that's going to be very critical to what goes on with at least CCRCs. I think that's going to put a lot of pressure on the nonprofits who just can't go do another bond deal to go save themselves.
Rick, when you're looking at the,
I gotta follow that.
when you're looking at buying buildings for And because you guys with Ventas, I mean, you guys have been spending.
And plenty of others too. not just them.
But millions of dollars on
Yeah.
renovating. Where do you find the best returns in what you're doing?
So ultimately we manage for many different types of owners. We manage for permanent owners, we manage for private equity owners, we manage for kind of hybrids in between. And so everybody's looking for something different. And so there's space for everybody. So take the more permanent owners, or even the call it the 5 to 10 year, we'll call it even 7 year-ish type investors. For them, the redevelopment plays are great. You have right now an environment where, because of some, it's certainly in certain markets, some overbuilding, you have occupancies that can be a little bit muted from where they've been. You can get an entry point for somebody to enter in now. These buildings are often, because they're in, especially when you look at the bigger growth cities of where you're seeing supply, where these buildings are located are where all the old people are. And so part of the issue is that they're maybe 20 years old, but they also may be the best piece of real estate to compete with the other ones. So the job that we do is to repurpose that. Now, not every piece of real estate that you find has the right bones, has the right possibilities for that. But frankly, when you look at, as Scott was alluding to, when you start to go into the 7-8 year horizon periods going forward, it may not matter, because you may have to build 10, 15, 20, 50 buildings a year in some of these markets in order to keep up. Now, that gets into all different kinds of theories about continuing penetration rates being in the same way, not different consumer demands, maybe penetration rates go down, maybe they go up, affordability, all sorts of other things, but it still comes down to, location, and people are going to want to have, I believe, seniors are going to want to, especially for, in the assisted living and more of the care-based areas, where they're going to be in areas where they're comfortable, areas that are close to excellent health care, and areas that are, near family members that are of their vintage.
Let's move on. We've got a lot of capital providers here. We're going to have some questions at the end for everyone, if you don't mind. Can you be patient?
No.
No. Let's talk about capital. We have a lot of capital providers here. David, is there such a thing as having too much capital in the senior housing market?
Well, the bad news for the CCRC guys is that we don't have that problem. It's very hard to find good capital in CCRCs as opposed to the businesses these gentlemen are in. So they are in the land of the capital providers. We covet every one we get and love them dearly, because the trickle-down theory has not come to CCRCs as it has in other...
But you see what's going on out there with not only the debt capital, the equity capital, foreign capital, sovereign capital, all coming into the market. Is this too much? Or is it never too much?
Maybe that's a question over here.
I don't think it's slowing down.
No, but you think there's too much capital? I mean, not whether it's slowing down, but is there too much capital right now?
Is there such a thing?
I think there's a fear that there's too much capital, and is it a bad thing? Yeah, it is, because you get too much of anything, it's always a bad idea, right? Anything, and too much capital forces you to make bad decisions. We've seen this movie before,
Yes.
right? It's too much capital going in, too much debt, too much equity going into something. Pressure to put it out. You're gonna fudge fundamentals. We all know, we've all sat behind the desk or in the chair where we looked at underwriting and saying, oh, this is great, oh, this is good. Growth rates, cap rates, exit cap,
But it's also
debt to
going in the
equity.
wrong places too.
Well, it's going to, but you can, my point being, you can take any scenario, any investment scenario, and put the rosiest picture on it that you want if you're forced to put money on. And I go back to the tried and true, wonderful private equity mantra, which is when you partner up with an operating partner, our group in this instance, and you're forced to put your own personal money into it. That's what cuts out all the bull. And so you're only going to promote things that you are absolutely sure are going to work for self-preservation. I mean, it's that simple.
So in today's market with the big three REITs, you know,
Smart money.
Yeah, exactly. Smart money. That's how you do smart money.
today with the big three REITs really pulling back from the investment side, I mean, they're in a divestiture mode, not an investment mode right now.
But are they? I mean, are they really?
They are. In the totality of their,
Yes and no.
0.0 something percent?
They're-
They're divesting?
selling off a lot more, or trying to sell off a lot more than they're buying.
Aye.
HCP, when was the last time they did a deal? How much is Welltower divested? How much has,
But they're selling like, 10, 15 properties? They're not really buying.
they're selling billions, they're selling billion-dollar
There's a
portfolios?
billion at least ones too.
Tory resale, they just, Main Street just bought that. What are you talking about?
What?
I think
Yeah, you're right.
REITs are actively buying.
Well-
They're consolidating, buying.
The consolidation is a little different than buying 100 properties or 50 properties. They're selling 100 properties
Well,
and 50
they just bought
properties.
Tory's company.
What?
They're also just reallocating to go do more buying.
But will they? You don't think they're nervous about it right now?
I think on a net basis, there are more sellers than buyers. And some people are reallocating, and some people are repositioning among senior housing.
Yeah.
But net, it's a loss versus a gain.
And that's very different from the past 5 years.
Yeah, well, look, I mean, they're short-term earnings animals.
I mean, if you look at the market, everyone was like, "Oh, we can't compete with the REITs." Well, I don't really see people complaining about the REITs now. They're complaining about the private equity firms, right? Our private equity got very aggressive.
What do you mean? What were they complaining about?
Other buyers could not compete with the REITs because the REITs would come in and they had the low cost of capital. They could pay the highest amount, and they had abundant capital. They're not putting.
Do you think that private equity money is cheaper than REIT money?
I think private equity is looking at and doing more than REIT money
But
today.
it's not cheaper.
It's not cheaper.
It's not cheaper.
It's crazy expensive.
It's
But it may be
It's just
more
they're filling the
creative
void,
money.
though.
They may be more creative money.
It's also, it's return timing.
And they
It's-
don't put
it's-
and their equity goes down very quickly when they do the debt recapitalization.
Yes, that's true. But it's also that they look at the other swatch of 11 asset classes and they say, well, these returns are horrible. Let's triple down in seniors housing. And then they convince themselves in investment committee that it's not something that it's foolproof because it is recession-proof.
Tori, I'm going to pick on you now because they brought you into the conversation.
Dave.
But
I talk chair.
you weren't even supposed to be here.
Kevin,
I had to beg to get in there. Come on.
But I go through every quarterly earnings report of the REITs to look at every acquisition they're making, and it used to be, oh, we're doing 200 million here, and it's like, well, we did a $26 million assisted living acquisition. I mean, it's peanuts compared to 3 years ago. Do you not agree with that?
I don't know what to say. I really don't know what to say. The bigger REITs I don't see the same level of activity, the same acquisition activity that we did before. Our deal is kind of perfect size for two non-REITs, so we're not a REIT anymore, they're not a REIT, and it was a good combination. Platform will be good. Those kinds of deals I think happen.
Yeah. Well, I just, it just seems it's just so small deals now, not the big stuff of the past. But, and that brings up my next question. You look at exit strategies, all these private companies out there. You go back 10 years ago,
How about Sabra recently? Sabra's
Sabra,
acquisitions.
they bought
but they bought a
Ray
REIT.
Lewis, yeah.
Yeah, but I'm talking about buying 10 properties here, 50 properties, not an entire company. That's a little bit different than that, and that's a whole another animal.
But they also
But-
weren't as acquisitive as all the other ones at the time, so.
Yeah, but Sabra just bought 50% of the line.
Been live.
Yeah.
And there were, yes,
So I mean, that's,
and Sabra, okay. Now, is Sabra different from every other REIT out there right now? Is there any REIT doing what Sabra's doing? The answer is no.
But they didn't buy in the same way from 2010 to 2015, so it's also about portfolio allocation too.
Right, and they're buying because of their portfolio.
Right,
They need to diversify.
right. And so the other ones are going into life science and medical office and hospitals
Yeah, right.
and campuses because they weren't, because they were in senior housing for a while. So and that was my point about, give it time. Once they reallocate.
Oh, it's going to come back. I'm just talking about today.
Right.
Because the exit strategies today, what do you have? There's no public market. No one can go public today in our industry. If you want to have an exit strategy with a REIT, it's, you may not get the price. You're not going to get the price you got 3 years ago or 2 years ago. So how is that impacting the market? You think where people are looking around and I can't go public. I don't know if I want to be with a REIT because look what's going on with some of the REITs today. What's the exit strategy? Blackstone.
The good news is when you're building in a protected market, there's still plenty of buyers who don't want to take that learning curve of actually spending the 2 or 3 years building, who are happy to buy that brand new building that you just built up. That buyer is still there.
But Blackstone's exit strategy is clear. 'Cause it's
They'll just go into their private
No,
REIT
exit,
or.
exit
but they have-
strategy,
but-
two
but they-
Blackstone.
oh, two Blackstone.
Blackstone.
Sorry. Never mind.
Or KKR.
But there's also not that much real estate that's owned by private operators anymore. It's all owned in other institutions, so it's just trading between institutions if they want to exit.
We talked about Scott's active adult communities that he's doing, and he really thinks that's, and he's not alone, by the way. There are a lot of people doing that. A lot of multifamily operators are thinking, well, we'll just convert my apartment building to active adult. It's going to be the wave of the future. What else is going to be, what other alternatives are going to be out there? I mean, there was Bill Thomas came out, the greenhouse Bill Thomas, not senior star, with I think it's called the Minka building, the 350 square foot pod that you can either put on and have grandma live in it on your property in your house, or you can decorate a CCRC campus with all these. I mean, everyone's trying to come up with a solution. Are there going to be, solutions? Scott.
Me? Yeah. Sorry. Give an Irishman a drink and he talks too much. There's the first, right?
what is the future, Scott?
What's the future, Scott? We want to know.
So I think the future is great, and I love this industry. I love what we all do, and the reason for that, again, is not demographics, but we're so this industry is 40 years old.
Right.
It's 40 years old. It still has a lot of chicken on the bones, a lot of things to figure out. We're through first generation, maybe second generation, but
And in earnest, it's really more like 20.
yeah, exactly. So hotels, okay, we've done that, right? Multifamily, cap rates are 3, 4. It's ridiculous. Everybody's figured that stuff out. Here we're at cap rates, 7, it's probably high, so good markets. 7, 8, you can go 10. Point being this: there's a lot of things to innovate with the space. And in particular, we've got what we call the Bill of Rights. We've got 20 things that we want to have all of our new developments have. And it's everything from like first floor memory care, right? Let's put memory care on the 3rd floor and put them in a room half the size of this one so people can mill around. It's horrible. It's torturous. First floor memory care, giant, walking gardens. things like, key fobs, as opposed to making seniors put keys in locks, or even, something similar to that. 9-foot ceilings, bistro off the side, on and on. There's test kitchens, getting rid of the private dining room. It's a dinosaur, right? There's things that we can take with the current box and innovate it and make it better without radically changing it and putting people in pods. I don't think seniors are ready to go into pods. Sounds like horrible, right? Pods. Who wants to go to pod? I'm not going to a pod.
They're really hard to operate. I mean, not just on the operation side of it too.
Do you guys think that technology is going to impact your business model in 10 years?
It already is.
In a good way or a bad way?
It's happening right now. It's happening right now. We're rolling out technology suite products to, our caregivers, for example. Our caregivers don't carry clipboards anymore. They carry iPhones and iPods. All of their care stuff is on their phone. They click. They don't have to go back to the care office and write anything down. Write notes immediately. Immediately uploads to our system. Goes to billing. Answers customer questions. Timing. Can get into our pricing models immediately. Makes their job easier. In a world where caregivers are hard to keep, is the right answer to pay them more? Yes, well, you're going to have to pay them, but what if you pay them as much or maybe a little more than everybody else, but you make their job 25% easier?
Color commentary to that, I've been to the home office of Atria, and we call it, with respect, we call it the Willy Wonka's chocolate factory. It's like
an R&D department.
It really is an R&D. It's super impressive, and they've got their own. They've got a printing area where they can make, professional test case. Hey, come to the Kentucky Derby in the so-and-so room and send it out to Atria, Cherry Hill, Denver, right?
We do all of our own in-house printing and marketing, and both digital and print all in-house.
That, and you've got you've got your CapEx, area. They're super innovators. It's really impressive. And then you look at what they've done and what other groups are doing, and where the caregivers have phones, and they're basically tasked with make sure you check on Dr. Jones's room. He needs a salt-free diet. Make sure so and so doesn't sleep past 12 o'clock. They send this stuff from the headquarters, not these guys, but other people. They send it from the headquarters, and I'm going, oh my God, George Orwell has invaded our space, right? It's Big Brother. But who wants to work in a situation like that? And the answer is a lot of people want to do that. They in this generation of technology, everyday technology, where everybody's checking to see if they got likes on their post on Instagram or Facebook. You get that gratitude from that. A lot of folks want to just say, okay, this is what my task at hand. Did that, and you get the the endorphin high off of having checked the box. And it's a great, efficient operating model, which I think has got a huge place in today and go forward.
And it's just the beginning, because ultimately answering and using technology to smartly answer labor questions, to efficiently, and because the Holy Grail is price points, is being able to figure out how to deliver quality service at multiple price points. We're teasing out multiple brands and all sorts of things like that, and kind of along the lines of what a Marriott model looks like at different price points and things like that. And how do you do it? We're still at the early stages of it, but that's what's really exciting, to be able to move that part of the business into the modern world.
Let's talk about, we'll get to some questions in a sec. Let's just finish on labor. How much of an impact is the shortage of labor and the cost of labor having on investment values today, whether you buy something or building something? Is that?
I think labor turnover has such a huge cost attached to it for a lot of reasons. Everyone in all these communities love their caregivers. They don't like to turn over themselves. The cost of replacing caregivers is huge. And you need to solve that model, I think, by paying caregivers a higher wage than the neighborhood place, and looking to keep them longer term, because residents in general love their caregivers, and gives you a differentiation point that a lot of competitors don't realize or perhaps take advantage of.
And the trick with it is that you can only afford to do that in places where you can charge rate and get real rents and real rate increases. And so it becomes harder in more commoditized markets.
Exactly right.
The bar remains open and there's food out there, but we have a couple minutes for any questions. And yes, in the back.
In the back. All right. So, David, Scott, you talked about the CCRC. You're talking about what's your price point? I mean, you read all these articles about how about population is aging, baby boomers. They're not having to save any money. Are they going to be able to afford senior housing alternatives? We're talking about penetration rates that high. But what are your price points? They have to be high.
It depends. No, it really does. It's like, but tackling the heart of your question, it's a great question, by the way. It's like, we call it the candlestick. It's like we all have these delusions of grandeur. Hey, we're going to start, serving the everyman, right? We all want to do that.
Wait a second, don't say that. I don't want to serve the everyman.
Okay, well, I do. Okay, but you want to attack the middle income folks, and so the price point that we're shooting for in any town USA, which is a good market, it's still an NFL city or one of Schles's 33 cities. It's $1,800 to $2,500 for a one bedroom. That's what we want to attack. So how do you get there? You get there by buying land smartly, and then the real trick is finding a good GC who's going to do that box for you for like $150,000-$160,000, right? And then you come in all in at $200,000, maybe $225 per unit, and that's the tough part to navigate. But if you want it, it's the key. Yeah, it is the key. So something's got to give. You got to find that contractor. You got to take crown molding off, or you got to buy land. It's farther down the road.
Contractor inside.
Yeah, or contract. Yeah. Well, la-di-da.
No, not us. We don't. But that's what Holiday did.
Yeah, exactly. Yeah, so
Very
you can bring that.
successful.
You bring that inside. Yeah, you're right.
Yeah,
You're right. So
very
you get rid of the the markup associated with that. But if you want to hit that price point where and you want to grow that everyman market and build active living, 55 and older, 72. That's how you got to do it. You got to start with the land and find a good contractor that's going to do that.
Are any of your 55 and over communities geared towards the everyman?
That is the objective, and so we've bought a couple of properties that we've renovated towards that. So yes, on those, but the ones that we're building right now, we're still at the front end of it. So ask me next year.
What's the
That's the
total
goal.
number of units that these communities typically?
About 160 to 180. That's the assisted living / memory care sweet spot of 90 units,
Right.
where 25% of them are dedicated towards memory care, called 18 units dedicated towards memory care. That's the model. That's the bread box.
Not in your activity, not in your activity.
No. That's assisted living. It's apples to apples comparison.
David, on your increase fee project, what's your price?
Very high.
Yeah.
But we're still gonna find something for you.
I'm not old, and I'm the age that you guys are talking about.
I know, and that's the problem. No one wants to leave home, which is why I think you need the full continuum of care. But we actually look really carefully at what the average price of the housing is and where we're going, and then we really want to match that. And if we can't match that, whether it's brand new construction or distressed buying, you just better stay away because you're just not going to beat it. You really got to be where that market is in a standalone house.
Can I ask a question? I know I'm not supposed to be.
You may.
Kevin.
So, yeah, thanks, Scott. Jim, there's a Jimmy Buffett, you saw that, active retirement. They're on phase 2, they're sold out of that. Is that the new thing that you think it's gonna come in? So it's independent, do you know what it is?
Oh, yeah.
It's a Canadian developer, and I think it's like 164 units, and
It's Margaritaville living or
That's
something like
correct,
that.
it's not too far from the villages, and it's independent living with some active 55, and it's like a hot potato. So is that
That's
the new
ex-
thing?
that's the extreme example of what it is. You know, you look at when the industry started, you had, you know, the greatest generation, right? They kind of kept their head down, they served their country, they did their thing, they married, they retired, and they just hung out, right? Active living is completely different. Their life's not done. They want the next thing. They want the third act
Right,
of
that's
their
why-
lives,
exactly.
right? They're not ready to say, I'm not having fun anymore, and I'm not going to go to a restaurant because it's too expensive, or go to a movie. They want fun in their lives, and that's why this kind of thing is going to take off.
So David, you can do something in, where's it, Deer Valley? You can do a lifestyle type.
You know, every time I go to one of those places and hear that music going through the elevators, I think, you know, this is just not for me. I don't know. Maybe I like
I
a little
just
more
wonder.
quiet in my elevators, but in Margaritaville, you know, it's a different, I think it's also a different price point. I don't think that's the everyman price point. I think that's one level below the everyman price
Do
point.
you think so?
I do.
There?
I do.
I don't know if I can.
So a question for Scott and Rick. Do you do any type of extrapolation of the housing price in your markets based on and how that relates to the rent that you're willing to charge when you're looking at new markets in both the, I would say, you know, Scott, you're active adult. How do you analyze that aspect? And Rick, you too, when you're looking at particularly your independent living, how do you extrapolate, you know, what does the average cost of a home look like? What are the assets? And how does that parlay into what you think you can charge for rents?
So, I mean, Scott knows this because for the, I don't know, the half dozen deals that we've, you know, either started talking about or have worked on together, the first thing we do is a demographic study for our customers of what we think, looking at supply, demand of existing stock, using it home values, and we have 210 communities in the U.S. and Canada, so we have a lot of data that we can look at for how general penetration rates work in multiple markets, how they work across. It's hard to project what housing prices will do because housing prices can be very bubbly, and so I don't know that we're not doing any active living stuff together, so that's a different marketplace than the traditional assisted living, independent living, memory care stuff that we do together. And while housing prices are an important factor into it, you don't really need to look that far ahead because you're not talking about potentially a 20-year horizon for even some customers. I mean, you can have customers in some active adult things that can stay that long. So for us, it's a little different. It's gonna move much more quickly, and is not necessarily going to be as driven because of the fact that care is going to be a bigger driver, and need is going to be a bigger driver for why people make decisions.
And also as a rental though,
Right.
I assume people are selling their homes, they have a chunk of cash when they're moving into your communities.
Right.
So there's not that direct correlation
Correct.
between that house price
Correct.
versus the
And-
rental rate.
But there's still some correlation.
And in some ways, to be honest, in some ways we look at correlation, certainly in our markets, we look at correlation as much to the S&P as we do to housing values, because the percentage of people's wealth that is outside of their home may be just as great or greater in some of our markets than, and so it's not necessarily as directly correlated for our product per se.
And color commentary, Rick is exactly right. That's the starting point. And here's the playbook. You've got take your address, 5 mile ring, number of qualified caregivers, which are the adult children, qualified seniors, median household income, median household value, to your question, and then that's the science, and then the art based off of Joe McElwee, who's on our team, who's the guy who's responsible for first and second generation of all the sunrises that populate the East Corridor, which gave rise to this entire industry. He's like, would you put your mother there? So you hit all those hurdles, your benchmarks, and then you pull up the site and say, would you want your mother there? And that's when you decide whether you're going to go forward or not.
I have a question. David, you mentioned the skilled nursing business before, and obviously none of you are directly involved with that business, but I'm curious. I mean, obviously you've all kind of watched this as many of us have, maybe as interested observers, but a lot has happened in the past 24 months or so. I'd just be curious, like, where do you see the skilled nursing business going from here? What's the future of that?
Well, I think that as a Genesis board member, and unfortunately sold was very long Genesis stock, I think that the whole disruption in the whole pay system is so systemic that I see nothing but carnage for a couple of years to come, because everyone has to get to the new reality. And whether it's hospitals who are, not discharging people and then they're calling on their holds, or it's just so many things are happening in rehab that I think the whole industry is going to have a huge reset. And I think that's what's really happening now. And I think that happens for another couple of years, truthfully.
But I'll do a second after that. Everyone thinks, oh, no one wants to be in a nursing home, it's going to go away. But you look at the typical nursing home patient, these guys don't want to have that nursing home patient. So that patient's got to go somewhere. So to think that it's going to go away because we don't like nursing homes, it's not dealing with reality, because the private pay market's not going to take them. It's just a question of what's going to happen with the funding. But I don't see them disappearing, and especially with the 10,000 baby boomers turning 65, they're going to turn 85 at some point. So, but there's definitely the shakeout has begun.
And people are living longer. So
Right.
more.
Skilled residents are on the outside looking in. It's horrible. It's horrible. That's the biggest thing we've got going on, is because you have to factor in the government to take care of them, and then that crowds out the private guys.
In the back.
I have two questions for Scott. First is, have you been contacted by Dos Equis?
Stay thirsty, my friend.
It's under in the end, it's all in the end.
On that note.
Second question, are you citing some of your age-restricted housing near existing, more traditional seniors housing communities that you have an interest in, or that just happen to be there? Is that important? Is that an important criteria?
Oh yeah, absolutely. But it's more of an intangible. It's like the, hey, would you put your mom there? What Joe McElwee would say. It's like, you want that continuum of care. It's what your whole business is based on. It's like, and God love those people who make that decision, that say, all right, I'm going to move once. I'm going to go to independent living, but I know that behind the Chinese wall is assisted living and memory care and skilled nursing or memory care, and they make the heady decision that this is it, because they want to make sure that for their spouse and for their family, that they're not moving around too much. And if you can emulate there or supplant that concept with having the continuum of care within a mile radius, that's nothing but a good thing.
So, yeah.
Yeah, another question for Scott on age restricted. So it seems like tech-enabled services is going to be a vital part of the whole system. So especially with regards to extending the average length of stay of the residents, whereas they might otherwise transition into IL or AL. So can you just talk about the experience you're seeing with the current kind of 70 to 80 cohort and their reliance on apps like Seamless or food delivery or Uber, for example, or home health?
That's a really, that's a great question, and it's a crux of, I think, the success of age-restricted housing or active living, and it's something that's hasn't been entirely figured out. What our view is that you want a great community center to be, the center of the whole community, and so you got this great space. You design it again, Playbook. You design it more like the Delta, Crown Room, where it doesn't have compartmentalized walls and spaces and meeting rooms, blah blah blah. It's just okay. On this side of the wall, you're gonna have your guys watching the football game. This side of the wall, you're gonna test kitchen. Here, you're gonna be the library. Down here, you're gonna be doing activities or day of activities. And so, but you keep it open, you keep it, very social, but it doesn't work unless you get the number one person the most important person within this structure is the activity structure. You get somebody that's super crackerjack that takes what you're saying and makes something that's super complicated, like set up a Facebook account as an activity, and this is how you're going to communicate with your grandkids. So, front end of evolution, a lot of folks are doing that, but you want to center on that as a way to develop your community, but also become a driver from a marketing standpoint.
All right, last question.
So we talked about demographic demand, and we talked about equity capital out there, but as a private equity investor who invests about 10-15% of the capital in this space, I haven't heard anybody touch the capital markets. From our perspective, the first deal we did in senior housing was 4 years ago. We invested in office, invested in hotels, invested in multifamily. The first deal we bought was broken IL deal. We borrowed LIBOR 188 from the agencies. But we're not seeing just agency debt, we're seeing balance sheets too. So I guess we sit back and wonder, paranoid again, just with half the foot in this industry, how much the capital markets is driving this. So interested in what you guys are seeing from a borrowing standpoint, and does that keep you up at night as it relates to the cap rates and the potential liquidity and the impact that has on exit over the next 5 years?
I can take it. In general, I mean, it depends on what you're looking at. For stabilized stuff, there's tons of liquidity out there. The issue is more on on development capital, where it gets a little tighter. But there's also plenty of especially with HVCRE and some of the other things that are going on with with traditional banks. There are plenty of other private equity businesses that have huge debt businesses that are a little bit higher spread, but are still putting out lots of money, even especially if you don't go very high leverage, it can be still very attractive debt. So I don't see a lack of liquidity on the debt side, and on the equity side, I mean, look at. I was just talking to Craig about this before. You look at the Dow at 24,000, and you think about institutions that are going to reallocate starting in the beginning of 2018, and they're going to have to increase their real estate allocations now because of just where the overall stock market is. And so, that's just for the public players. Then there's all the sovereigns coming in as well.
Eric, I think your question is answered by the brief history of this industry. Take it back 15 years. institutional capital stayed out of seniors housing because it was operationally intensive. They didn't understand it. They didn't realize that the way to solve it is through having a good operator. The insurance was a total scam. It was like, there's so much insurance money going towards, it was a huge drain on the NOI or the bottom line. And then the last thing was headline risk, right? Grandma slips and falls, all of a sudden you get implicated on it. Who wants that, right? So that's what institutional capital stayed out of it. They were driven into, institutional capital was driven in the arms of seniors housing based on the fact that multifamily was trading at, sub 5, which was a big deal back then, not today, sub 4 cap rates. So you got to turn somewhere else to get your yield. So they looked at seniors housing, got into it, and realized, hey, these waters aren't so cold after all, right? This works. And then as soon as the early adopters, AEW, Carlisle, gotta love them, got into this thing, and they didn't get burned. They didn't realize that the insurance thing was not as big of a deal. Then everybody's like, oh wow, these guys are getting 8% yields, 8% cap rates. Let's go. And so that's the blessing of the curse. A lot of institutional groups got in there, and that started to drive cap rates down.
But you also have now much more core money in this that you never had before.
That's the other new it girl, is core, right? What does core mean? I mean, is core?
What is that?
Core money is
predictable.
It's equity yields in the mid to high mid to semi-mid single digits.
Which is less reliant on that, what you're saying.
Yeah.
Right, and that's where all the, we talked about, somebody asked a question about, is there too much, money getting into there? That's where it's now finding new fiefdoms or fishing holes to go, and core is like the new one. It's like still ill-defined, but it's where's the safe money in seniors housing going? The 5 and 6 yields.
And where does it go if it's investing in apartments of 3? I mean, that's the alternative.
I think the question I ask is a little different. Look, we do see regional balance sheet lenders, for example, leaning into projects that we view as riskier than many other things they could do with their money from that perspective, at cheaper rates, looser lending standards. So I guess it's just a function of where you got in the capital markets, or you're not in the core stuff, sort of like the fringes and some of the capital markets.
You're going to have that. I mean, you'll have that in all cycles.
You still can't find better yields in private pay real estate sectors, the 12 real estate sectors, than seniors housing.
But also historically, when some banks fail and lenders exit, there's plenty of people that tend to step in, whether they know the space or not. They don't know the space. There's never been a lack of, really never been a lack of depth in this space. For the 30 years I've been in it. Maybe a few years in the late 2000s or 90s.
I tell you, for me, it feels like there's more mezz and there's more equity than there is debt from lenders. And I think the lenders who are out lending, at least in my space, they're lending much smaller amounts. So now you need to club them together to get something worthwhile. Versus you used to be able to find one guy and then he'd go sell it down on his own right. But there's a lot of cash, a lot of mezz running around versus, traditional banks, regional banks. I don't see them anywhere near as active as they used to be. I don't know what you see, but...
Well, some of it is the HVCRE problems of what they have to do for their carrying costs.
HVCRE is definitely equivalent or a regulator on capital lending.
But there are other people that have stepped into the space that don't have that don't have those restrictions.
At a higher price.
But not meaningfully higher.
Okay.
Well, the bar is still open, and there's still plenty of food out there, and so I guess if you want any other questions, you can talk to them individually if you'll hang around for a little bit. But thank you three for coming and being on this panel here.
Thank you,
Well,
Steve.
thank you.